What if I told you that companies integrating sustainability into their core strategy are seeing 28% higher returns on capital, that they're accessing cheaper financing, attracting top talent, and commanding premium valuations? This isn't charity, this is smart business. The evidence is overwhelming. Integrating ESG factors with the UN's Sustainable Development Goals has moved from nice to have to business critical. But here's what most executives miss. This isn't about doing good. It's about competitive advantage, risk management, and capturing the largest economic transformation in a century. In the next 7 minutes, we'll show you exactly why ESG-SDG integration is your competitive advantage, what happens to companies that ignore it, and how to start building this capability today. Let's start with the numbers that matter to your bottom line. NYU Stern analysed over 1,000 research papers and found positive relationships between ESG performance and financial returns in 58% of studies. Harvard Business School tracked companies for 18 years. Those with strong sustainability performance significantly outperformed on both stock market and accounting measures. S&P Global showed companies in the top quintile of ESG performance demonstrated average return on capital of 28% compared to 15% for those in the bottom quintile. But here's what's changed. This isn't academic theory anymore. Financial institutions like West Africa's EcoBank are now making ESG performance standard for all lending decisions, even for small businesses. Major oil companies won't contract with suppliers unless they demonstrate strong environmental and social credentials. McKinsey identified 5 specific channels where ESG creates value: top-line growth, cost reductions, regulatory advantages, productivity gains, and asset optimization. This isn't coming, it's here, and it's accelerating. ESG-SDG integration creates what we call the triple value opportunity: simultaneous benefits for your business, your stakeholders, and society. On the business side, you're looking at measurable value creation, revenue growth through new sustainable products that tap into the $35 trillion in sustainable investment assets, cost reductions through resource efficiency. Companies are saving 10 to 30% on energy costs alone. Enhanced access to capital, with ESG leaders enjoying 10 to 20% lower cost of capital. For stakeholders, you're building competitive advantage in the war for talent. 73% of millennials will pay more for sustainable products, and 76% consider a company's social commitments when choosing where to work. Companies with strong sustainability programs have 55% better morale and 38% better employee loyalty. Societally, you're addressing global challenges while building your social license to operate. But here's the key. This isn't 3 separate strategies, it's one integrated approach that multiplies your impact and returns. When Unilever integrated sustainability into their sustainable living plan, they saw their sustainable brands grow 69% faster than the rest of their portfolio. When Interface committed to Mission Zero, they didn't just reduce environmental impact, they saved $500 million while building the strongest employee engagement in their industry. This is strategic integration, not corporate charity. Now, this isn't one size fits all. Every sector has unique ESG-SDG value drivers. In financial services, it's about risk management and accessing the growing sustainable finance market. Banks like JP Morgan Chase committed $2.5 trillion to sustainable development by 2030, not for charity, but because they see where the market's heading. For manufacturers, it's operational efficiency and supply chain resilience. 3M's sustainability initiatives have saved them over $2.2 billion since 2000 while reducing environmental impact by 75%. Companies are saving 10 to 30% on energy costs alone through ESG-aligned efficiency measures. Consumer goods companies are capturing market share through brand differentiation. Patagonia's Don't Buy This Jacket campaign actually increased sales by 30% because consumers trust authentic sustainability commitments. Technology firms are building trust through responsible innovation. Microsoft's carbon negative commitment by 2030 isn't just environmental, it's strategic positioning in a market where data center customers increasingly demand sustainable providers. Energy companies leading the transition are positioning for the multi-trillion-dollar clean energy market. Ørsted transformed from an oil and gas company to the world's largest offshore wind developer, increasing their market value by 300% in the process. The key is understanding your sector's specific opportunities and acting on them strategically. Here's the game changer. Financial institutions have made this decision for you. 84% of asset owners globally are pursuing ESG integration in their investment processes. BlackRock, managing $10 trillion, won't invest in companies that don't meet ESG standards. Banks from Wall Street to West Africa are making ESG performance mandatory for financing. EcoBank requires ESG reporting even for small business loans. Green and sustainability-linked bonds reached $700 billion in issuance in 2020. Insurance companies are pricing climate risk into premiums or refusing coverage entirely. Central banks are incorporating ESG factors into stress tests. This isn't activism, it's risk management. Financial institutions have analysed the data and concluded that ESG laggards represent material financial risk. Poor ESG performance signals weak management, inadequate risk systems, and inability to adapt to changing markets. Strong ESG-SDG performance indicates strategic thinking, operational excellence, and future resilience. The question isn't whether you believe in sustainability, it's whether you want access to capital, insurance, and investment. But what if you don't act? The costs of inaction are becoming material and measurable. Companies with poor ESG performance face valuation discounts of 10 to 30% in high-impact sectors. They're losing market share to competitors, facing higher financing costs and struggling to attract talent. We're seeing customer migration, exclusion from supply chains, and regulatory penalties. Climate litigation is rising, reputational damage spreads faster than ever, and investors are actively avoiding ESG laggards. The evidence is clear. ESG-SDG integration isn't just the right thing to do, it's the smart thing to do. Companies that act now will capture the triple value opportunity, access new markets, and build lasting competitive advantage. Those that wait will find themselves fighting for survival in an economy that increasingly rewards sustainable value creation. The transformation is happening with or without you. Start with materiality assessment. Identify which ESG factors and SDGs most impact your business. Set measurable targets aligned with your sector's key performance indicators. Integrate sustainability into your core strategy, not as an add-on. The question is, will you lead this transformation or be left behind by it? Start your ESG-SDG integration today.